I'm Carson Block, and welcome to A Short Story. I'm pleased to be joined this time by Chris Brown of Aristedes Capital. Chris Brown and Aristedes are literally one of the best in the world at equity long short. They've compounded at about 15% a year since 2008 and have never had a down year. And having a significant short book is a big part of what Aristedes does. Chris, thrilled to have you here. I know we're going to learn a lot. Thank you for joining us.
Thanks, Carson. Thanks for having me.
There's a lot that's outside the box here. And to be clear to our viewers, this is actually going to be a great opportunity for me to get to know you as well, because we've never spoken before. We had one or two exchanges over DM, ironically not having anything to do with investing. You're in Toledo, Ohio, which is also unusual for a fund manager. How did you get here?
Yeah, I had a really, non-traditional background for a hedge fund manager. I used to be a doctor in the Air Force prior to 2008. I was a math and science kid, and I was an ASPE, and so I would go from one thing that I was really into to another. When I was in second grade, I actually kind of compulsively watched Financial News Network and really got into the markets at that point. So traded my first stock when I was 12. In medical school, we started an investment club. And actually in 99, I ended up starting a state registered investment advisor / commodity trading advisor during my second year of medical school. And I kind of realized at that point that medicine was maybe not the ideal career for me, and that the markets were kind of a lot more fun. Unfortunately, I had an Air Force HPSP scholarship to medical school. And so I asked the Air Force if it was possible to pay them back and leave school. And they said, only if you want to come be a line officer in the Air Force for 4 years. Finished school, did a military internal medicine residency at Wright-Patterson Air Force Base in Dayton. Stayed on there as chief resident for a year. Then I served as site clerkship director for Uniformed Services University for 3 years. And in early 2007, I started thinking about what I wanted to do when I got out of the military in the summer of '08. And I came across a great back-testable database product, built my first quant strategy in US microcap and started trading that. It's going really well. And I thought, I could do this for other people. Spent some time finding service providers and taking my Series 65 and reading as much as I could and getting up to speed. And we launched the fund in August of 2008.
In terms of going back to your background, doctor, and you said also ASPE, so I assume you're referring to Asperger's. So how often do you get compared to Michael Burry, and how annoying is it?
Early on, a little bit, like when The Big Short first came out. I mean, it would be a very superficial comparison. I think we're pretty different. I think our politics are pretty different.
There's got to be, something in your background. So okay, obviously you've got a mind that's well geared to quantitative analysis, to science. But when you look at that, I wouldn't say that's necessarily every doctor. Doctors, I think, are notorious for being really bad investors, bad business people. I think they were always like the easy marks of those boiler room brokerage firms in the 80s and 90s. I think that was like the big payday was getting through to a doctor. And also, we've looked at times at some biotech names that have had, when you really get into the clinical trial data, you see that the clinical trial data does not show efficacy. And yet a lot of doctors, when we've spoken to them, it's surprisingly based on intuition and anecdotal data. Like, well, this is what I observed. How much does medicine, or being in medicine, that branch of science, how much does that really set you up for investing, or is this somewhat just a coincidence?
The medical background can be both helpful and it can be a detriment. It's funny that you mentioned that doctors do tend to use a lot of intuition. Back from my medical education days, trying to teach other physicians about evidence-based medicine and about statistics was like pulling teeth. Like math is particularly hard for doctors. Teaching people to think in a Bayesian way and to be uncomfortable with uncertainty is hard, not for every doctor, but certainly for a lot of them. I would say the medical background is helpful sometimes in that one of our shorts that we've been a little bit public on recently is a company called Cytidine, where they have a very old drug from 1999 that they've basically repurposed as a snake oil. And CCR5 is a very popular target for pharmaceuticals right now. And so, they're like, our drug is going to be good for cancer and for NASH and for COVID and for a million things. And actually, like, knowing the pharmacology and being able to look back to the original studies, you can look and you can see, this the IC50 at this receptor is X, and the way they're dosing this medicine, the serum concentration is actually less than X. And so, whereas most drugs, you'd have like 98, 99% receptor blockade, this drug is blocking, less than 50% of the receptor activity. So it's basically worthless as a drug. Knowing that is really helpful. The things that have hurt me being a doctor, number one, the times that you get caught up in data rather than the basics of, I guess, some of the things you learn as a long-short manager, like whether management is trustworthy or not. So I've definitely had some misses before where I've been too trusting of management. And I haven't paid it. I've been more immersed in the data and less in the fact that it's a Salt Lake City-based company, which maybe I should have been. And then last year, COVID was just. It's funny. Unfortunately, I really nailed both the infection fatality rate and kind of the course of the COVID cases would take. Even in March, we had a gigantic 1x2 in the VIX because it was like super obvious that November, December, there'd be this huge ramp in COVID cases again. And I was just like so caught up in COVID that I was not sufficiently caught up in, how much money was being thrown at the system. And that was, definitely a mistake. Like we were way too close to market neutral for a lot of that time last year. And so, being able to like focus on the right things is definitely important. And I guess that's an ASPE downfall, right? Is you tend to perhaps sometimes focus on narrow parts of systems instead of seeing the whole thing.
I fault my own performance last year at the precipice of COVID for somewhat of similar reason. I got the toilet paper trade right. I mean, I nailed that. February 12th, I'm ordering all the toilet paper towels, canned food, powdered milk, got all that delivered. And we had a decent month in March when I was stunned. At the end of February, I read about this Evercore survey of their institutional clients. Pretty much everybody thought that COVID would be a non-event in terms of the economy. So that's when we said, okay, we have to go short. But we didn't. We should have hit it out of the park like Ackman did. I mean, we had a good month, but just knowing how early I was on the toilet paper trade and how focused I was just on survival as opposed to stepping back and thinking, okay, what are the market implications here? I almost fault myself as being maybe too emotional and not dispassionate enough to say, stop thinking about like how your family are going to live here. Start thinking about, how you can make money for your clients.
It's funny, like one of the lessons that I took away from it, I'm always like very sensitive to whether the market is telling me that I'm right or not. And I think one of my takeaways from last year is at certain times, like if you really have conviction in a trade, especially if there's cheap optionality that you can buy, you need to not always be sensitive to what the market's telling you. We lost a good chunk of money in February VIX last year. Because that was like, talk about being early on the toilet paper trade. Like I think we lost 40 or 50 basis points in February VIX calls. And that would have just been a killer trade if I'd had the conviction to re-up that for March. And instead, I just kind of retreated and said, all right, I don't understand what's going on. I don't understand why the market's still, not trading off of this. We had kind of a terrible start to last year anyway, because we had just implemented a traditional quant strategy. It was kind of long value, short growth by nature. And so even pre-COVID, January and February were just awful for us. It's crazy how much being right-footed or wrong-footed plays into the decisions you make in the market. If you're on the wrong foot and you're down on a bad day, you're just so likely to chase and do the wrong trades. And when things are really going your way, it's just so easy to take profits where you need to and lay out new positions where you need to.
Have you ever read that book, The Hour Between Dog and Wolf? Okay, it was written by, I think, a neurophysicist, and he became that after he was a credit derivatives trader. So it focuses a lot on how the hormones that our body produces in response to success, so testosterone rushes, or in response to stress and failure, cortisol, impact our decision making. And so you can get in these feedback loops, especially when you've been wrong, where your decision making is overly influenced by the presence of cortisol that you've produced because of your mistakes. Whereas, on the flip side, when you've had success and your body's just producing more and more testosterone, what that ends up leading to usually is taking too much risk for too little upside. So it's a physiological explanation for why that is, I suppose. You've talked about how when you first started managing money, you had a quantitative strategy. And I know you still run a quantitative strategy, but I think a lot of what you do right now is also qualitative or non-quantitative. I mean, that's really unique also. I don't know many people who blends that well. So I'd love to understand, to the extent that you're willing to talk about it, kind of what your quantitative strategy is, or at least what it was at the outset, the principles there, and how you were able to, how you look at things qualitatively, and are these just two entirely different ways of analysis, or is there more overlap there than I would suspect?
I guess second part first, I think there's a lot of overlap in some of the ways we look at companies. The traditional factors that O'Shaughnessy wrote about in his book, which a lot of which are in our traditional quant strategy that we brought out in 2019. Those have always heavily influenced my fundamental thinking about investments. And so, I think the idea that you want a company that has kind of consistently high returns on capital and lots of profitability, and those are kind of common sense things, whether you're going at things from a fundamental or a more quantitative aspect. Without getting into the specific details of our initial quant strategy, because it's still kind of a little bit of a trade secret, I will say one of the things we did there is we took a known, well-described academic phenomenon, and we basically drilled down to see, is there a set of stocks that this works particularly well for? That's kind of been a recurring theme with a lot of our quant strategies at the firm, is looking for things that are known phenomena rather than trying to have to invent something ourselves, and then basically trying to find an elegant implementation of that. One of the nice things about only managing, $140 million at this point is that, if a strategy can accommodate $5 or $10 million, it's still an interesting strategy to us. Whereas, obviously, if you're a $3 billion fund, then that's not going to be worth your time.
But the flip side of that, and really when you look at the short side, running a short book, the economics of that are often quite bad, because you really need a minimum capital base, most cases, to do the fundamental research. And that's, so you, like other short sellers who actually stay in business, you run about, I think about 80 short positions, give or take, right?
It's a pretty diverse book. Yeah, I don't know if it's that, or it's something on that order. Yeah.
Like I said, there are people who come into the business who try to be more concentrated, who think that, we're just going to really research these things and be right. But, unfortunately, being right and making money, especially on the short side, are not always the same thing. So when you think about having to have dozens of names on the short side, that's the bottom of your funnel. The top of your funnel, the top of the funnel for that normally would be enormous. And so I remember years ago when I first met Jim Chanos, and he was explaining that that's how they run their book. And I was just thinking, my God, how, the amount of processing that must go to get you to 60 to 80 names, to take it from the top of the funnel. Now, that's something that he was able to do as a multi-billion-dollar fund, and he had the processing power in the form of people. You, I'm assuming, don't run nearly as big as Kinnikos does. So I'm assuming that there's a lot you do with quantitatively or screening in order to work that process down.
Yeah, absolutely. I mean, we're not a quintessential or a Hindenburg where we're doing multiple hundreds of hours investigations on companies. It's just beyond the resources that we have. Our basic philosophy, it's funny because we tried that once. I mean, we actually tried to do some activist work on Montage, the Chinese set-top box fraud. We put a tremendous amount of work into it, had a very large put position, and I think it was about a 300 basis point drag on our portfolio that year. And I said, it's not a really good investment of our time. Our philosophy of shorting has usually been, why fight Mike Tyson when you can kick grandma in the shins? With the exception of the last 12 months prior to the last month, that has been a really good strategy. And unfortunately, last year you saw grandma took some methamphetamines and was raging and, collecting cash and knocking people out. So it was a really interesting time. I mean, we've obviously seen that revert very dramatically since early February.
What are the kinds of things that you short? And do you look for shorts that you feel are going to be good beta hedges against your long book, or you just look at shorts basically de novo? What are the things that I think are going to go down? Where are the grandmas who haven't seen their drug dealers in a while?
Rather embarrassingly, I hadn't really thought about quant factor hedging in the book much at all, and it's still it's not something that we really actively seek to do very much. I look at almost the longs and the shorts as two different processes, and I'm trying to generate alpha from both of them. And unfortunately, as 2020 kind of laid bare, like you definitely, in an unusual environment, like in a 98 to 2000 or a 2020 kind of environment, you do have a very significant factor risk when that's, you basically got the same factor risk on both the long and the short side. The bright side, when you get months like last month or this month, all of a sudden you've got, the same good factor exposure on both sides. So it's a happier situation. But yeah, we're looking for companies that have promised something that they can't possibly do, that have a very excited investor base that's very excited but not particularly knowledgeable and doesn't yet realize that management can't do the thing that they've promised they can do. Generally trading at a very high enterprise value to revenue, and generally burning a lot of cash and dependent on future financing. Generally, those things tend to burn themselves out.
Do you have a sweet spot in terms of market cap, or really all over?
Historically, I would say it was very challenging to find big companies that met those criteria. And then, kind of recently, I don't know, I think you might have seen our presentation on Tilray from a couple years back, but Tilray was maybe like a harbinger that this market might turn, .com mania again.
This is definitely a commodity business. Growing marijuana, reselling marijuana, extracting marijuana is all very commodity. Yes, you can point to niche markets within marijuana that are not commodity, but the big picture here is price comes down over time and it comes down aggressively. I'd say the biggest risk to our short thesis is someone making another brutally stupid $4 billion investment. I'm not sure why Constellation did this. Hopefully it doesn't happen again. I think by this point, people are less excited about the space and hopefully have figured out that's not a good allocation of $4 billion.
You really had not seen very many companies that were almost revenueless, outside of the biopharma space trade, to the kind of valuations that Tilray had. That was a great setup for us in that, when you get a company that's that ridiculously overpriced, that's still losing lots of money and doesn't really have, any sort of moat, that's a really good setup. So historically, I'd say a lot of our shorts had been, in the $200 to $500 million market cap range. They definitely started to go up market cap a bit with Tilray. Recently, just given how things have run, it's been very challenging to short anything that's really under 500 million or a billion, just because there's so much potential for, you don't want it to be the Reddit stock du jour and have it trade, 20 times its float in a day and be up, 300% on you.
It sounded a moment ago like most of the stocks that you traditionally focus on from the short side have a largely retail shareholder base.
Absolutely.
You talk then about how the shareholders are overly enthusiastic relative to what the company actually can do. And that was one of the really painful things, from 2020 and until, I guess, very recently in 2021, is that, this enthusiasm bubble didn't burst. It was quite sustained.
It just grows from more to more. Yeah.
Yeah. What bursts enthusiasm bubbles?
Losses.
Trying to do that, but if you're not speaking out loud, what bursts the enthusiasm bubbles?
Losing money burst the enthusiasm bubble. So, Tesla was this great doomsday machine for the shorts. And I think Tesla is where the gamma squeeze was perfected. It's absolutely insane the extent to which, options dealer gamma, as a percent of like daily trading volume, options dealer gamma is a very, very, very significant force in how Tesla trades every day. If you get these incremental inflows of retail call buyers, the thing just goes up. And if you get, incremental outflows, it goes down. And there's times when that doesn't necessarily hold true. Obviously you've got to model it out. I think that was where people discovered, hey, if we pour a lot of money into calls, things tend to go up. And when they do go up, it makes everyone's account balances a lot larger, and then they have more buying power to throw at other things. And so, and eventually people kind of got bored of Tesla, and they're like, well, there's smaller float things that we can make move much faster that are much more exciting to trade. Retail enthusiasm made those go up as well. And it's a very pro-cyclical process, obviously. And I think that's why you saw the implied volatility of a GameStop go to like 1,000 eventually, is as things go higher and higher, it's kind of a self-reinforcing process, and the vols go to the moon. And then at some point, people have, that lesson is learned. Like if I buy every dip, I'm good. And then they buy a dip and they have a catastrophic loss someday. When you take that 40 or 50% loss, it just totally changes the psychology of it, I think. Obviously you never say never in the markets, but I think, I for one would be absolutely shocked if we, rally back to new highs in some of these growth names. That would be like a remarkable thing to see. I think, it's reasonable to expect some sort of bounce, but you got to think that when people take the sort of losses they have in some of the speculative names recently, that's got to change psychology.